Welcome back to the Williams Real Estate channel. I'm your host, Geordie Williams, and today we are discussing the 18-year land cycle and how I personally am going to trade my investments in terms of stocks, super, property, what my plans are over the next 5 to 6 years as the cycle plays out from today to the peak of the market and then through the next land-driven downturn. So just a bit of housekeeping before we get into that. Just a disclaimer, I am no means a financial planner or advisor. This is general information in nature. This is my story. This is what I'm doing. Take it with a grain of salt, but it can't be relied on for any legal, financial, investment, tax purposes. I operate as a buyer's agent, so if this strategy resonates with you, hit us up. I'll put my details in the comments and happy to have a free 30-minute consultation to discuss your goals and our services from a buyer's agent perspective. But remember, as always, I can guarantee one thing: if you don't take action, you won't get anywhere. So if you have been following me for some time now, I I harp on about the 18-year land cycle a bit. Check out the previous videos; it goes into more detail around um, the 18-year land cycle. This video is how I'm actually personally going to what am I going to do the next few years based off my properties. I've got 13 properties across New South Wales and Queensland, and I've got stocks. I've obviously got super. I've got cash, and this is my plan as we enter the final stages of the land boom and as we go through the next land-driven downturn, which will be like the next recession, similar to what we experienced in 2008 GFC and what the baby boomers experienced in the 1991 recession we had to have. And if you go further back to even 1972 in the early 70s, there was a land-driven downturn there again. And this goes back all the way back to 1800 every 18 years. So if you study history and you understand the 18-year land cycle, it allows you a good time now to prepare, as what I'm doing, preparing your portfolio, preparing your wealth, to one, take advantage of the land boom that we're going through now, but then also protect yourself, your wealth, your assets, your family, and ultimately your ass of when we go through the next downturn, and set yourself up to be in a good position to start acquiring in the next downturn. So my experience, I worked with large construction and property developers, large corporate organizations, and what the property and the developing organizations do is they buy up sites during the slumps or the downturn. So the COVIDs or the dot-com busts or the GFCs or the 91 recession we had to have. That is when blood's on the streets. That is when the large organizations such as the Lend-Lease, the Mirvacs, Meritons, these big institutions, they buy up when it's tough times because you get good deals, you get big discounts. And then as the market moves on and the heat starts to run like we are experiencing now, that's when they start to then add value to those sites by way of renovation or development. So a lot of developers now, a lot in the media, a lot of build to rent, a lot of developers are talking up build to rent. It's not a coincidence that they're now all talking up build to rent. It's part of the cycle. This has been going on for decades of when they buy up sites during the slumps, best time to buy, and then it's the best time to then create more property during the upturns when all the properties stack up in terms of a value on those properties that makes sense to then knock down the existing asset, might be a warehouse or a factory, to then put high-rise apartments and rent them out or sell them, however what way they run their strategy. The large organizations typically run a build to rent model and a build to sell. So they typically buy a site, build 1,000 or 2,000 units, sell half to pay off the land, pay off the construction, and then keep the other half unencumbered as a cash flow that they can then lean on in terms of finance, so they can borrow against it to then buy more sites in the slumps to then keep replicating and keep growing their portfolio. So I replicate that obviously on a smaller scale because I started from scratch in 2017, but I replicate that exact same strategy of buying in the downturns like crazy. So I started buying in 2017, and to to the end of last year, I've bought 13 properties. So that was the best time between this last slump between 2019 all the way through to the 2020, 2023. That was the best time to buy. And then now, as we move forward, I'm now going to start developing my properties and adding extra dwellings as we go through the heat. So to give you a bit of a recap of what I'm sitting on now, I've got 13 properties across New South Wales and Queensland, consists of 2 townhouses up and around Brisbane. I've got 9 houses across New South Wales and Queensland in the regions, and I've got one block of 2 units or 2 flats. So out of the portfolio, I can subdivide 3 of the 9 houses, so I can cut them in half, which I'll do, and create a second title to build a second house. And the beauty of that strategy is, as I've bought the property for that 250 mark, once the market moves, as we go through the heat of the land boom, and the property is then worth 500,000-600,000, instead of going and buying another house in that same area and paying a premium while the market goes through the heat, I'll subdivide it. So cut the land in half, create a new title, build a second house for 250, and then leverage up the front house. So use the equity out of the front house once the value has doubled. Use that money to fund the subdivision and fund the build. And then once I then rent out the second house, I can then go back to the bank and then get another loan on the unencumbered asset. So I'm creating an asset that is then going to be unencumbered because all the loan is on the front house or the existing dwelling, and then allows me to keep moving forward as the market moves on. So it's a good strategy to get in wholesale. So instead of, as I said, buying for 600-700, once the market has moved, you can still acquire and build and add to your portfolio while the heat's going through the market and every man and his dog is getting FOMO and rushing in at the top of the market and overpaying. You can hedge the market by building, which is what all the big institutions do, is they build now as it becomes cheaper to build and manufacture more properties than continually buying when the market gets too hot. So out of the 9 houses, I can subdivide 3, so that's good. And then another 5, I can then add granny flats. So the lots of land typically to subdivide, you want around that 800 minimum square meters to 1,000 square meters to subdivide. In New South Wales government have brought in a new scheme where you can put granny flats on lots of land as little as 450 square meters. So between around 450 to 600, you can put a granny flat. So it's basically a small house, like a 1 or a bedroom small house in the backyard of the dwelling, but you can't subdivide it. It has to be the same title. So ideally you want to try and subdivide because then you get the additional title you can then borrow against. But um, if you can only put a granny flat, that's still okay because you can typically build a granny flat between 170 to about 200, 220,000, depending on the finishes. If it's a one or a two bedroom. So you're still getting in at that wholesale rate where these houses that I'm now looking to build are now worth four, five, 600 in the current market. So if I'm getting them built for that 200 mark and then renting them out for 350, $400 a week, that's 9% yield. I'm getting the good strong yield. I'm boosting my yield. I'm still growing the portfolio. Meanwhile, most people out there are buying overpriced assets that will most likely get burnt during the next downturn. So um, between 2024 and the peak of the market, my goal is to build 9 new assets. Oh, sorry, eight new assets. There'll be three houses and 5 granny flats. The 2 townhouses that I have, I can't obviously develop them. They're in a complex um, of with other units and villas. So these types of assets are good to get into the market when you're getting started. They don't you really need much capital. They're also good to if you own them interstate because you've got a strata company that looks after the common areas and maintains the property. So they're good to own one in say Brisbane or in Perth or in Melbourne if you're not located in that area. But for me personally, my strategy is ultimately you want to be able to get into buying assets you can develop. So I don't like going down the route of continually buying a lot of them, but one or two max, and then leverage the growth out of that into assets like houses and blocks of units that you can then develop down the track. So my plan is with the 2 townhouses is to sell them at the peak of the market along with another house I've got. So I'm going to sell 2 townhouses and a house. Um, Basically, I'm going to sell anything that I can't develop or I can't add a second dwelling because I'd rather sell that, pay down the debt. It'll increase my servicing. I can raise cash to protect myself while we go through the bull market because interest rates are most likely going to keep rising until they hit the peak and then they'll get dropped back to zero again. So I need to hedge myself against rising interest rates. So I'm protecting myself as we go through the heat. But then also once the market tops out and then we go through the next downturn, I'll be cashed up with very low debt to value ratio across the whole portfolio, which then allow me to then start acquiring again when the market goes through the next land-driven downturn, when there's blood on the streets. So also I got a block of 2 flats or 2 units on one title. I'm currently got a DA in with council that's up a hunter to build a third dwelling at the back. So I'm going to start building now until the peak of the market and then sell off um, the assets I can't develop. Before I sell them, I will get the tenants to vacate. Um, I like to always sell. I haven't sold anything before, but um, when selling a property, it's best to sell vacant because then you're selling to a broader market. Can be first home buyers, can be downsizers, can be retirees, um, can be even investors. If you're selling with a tenant, you're narrowing your people who are looking to buy that property just to investors. So sell vacant. I'm going to vacate the tenants, give them a cleanup. One townhouse is sort of ready to go, just probably needs a paint and maybe some carpet or flooring. The other townhouse needs a whole new kitchen and bathroom, so I'll do those renovations before I sell them to get the most out of them. Also, the first house I bought up in Maitland, 4 bedroom house. It's corner block, but it's only on a 300 square meter block. I looked at duplexing, trying to duplex the site to build 2 duplexes, but planning is still too tight up there. So it might take 20, 30 years by the time you can duplex a small lot like that. But for me, I find that the market's already moved. I bought for 240,000. I should be able to sell it by the peak of the market for 800, 900. I'd rather take that cash, pay off the debt, lower my debt to value ratio, get the cash out, ready for the next land-driven downturn, to then deploy that cash into say a block of 4 or 6 or 8 units, and then continue to carry on and acquire more and replicate again. So as we go through the next land-driven downturn, start acquiring, and then pretty much I like it would probably acquire in the next 18-year cycle all the way up into around um, just probably a year or two before the peak. So probably a year or two before the peak. That's where it's good to start developing, and then refinance during the peak, because credit is usually a lot easier. Lending will start loosening up because banks earn higher profit margins. They start loosening their policies. Um, you can refinance, pull your money out that way, and then when we go through the downturns, that's a good time to start acquiring. Um, so yeah, between now and the peak, interest rates are probably going to keep rising. Banks are going to start lending like crazy. We're already seeing as low as 3% deposits. So with no lender's mortgage insurance, if you can comply or apply for those schemes. So there's going to be more and more of this happening over the next couple of years, where lending is just going to get more and more easier, which will then fuels the land boom and fuels the final market peak through the top. So this is my plan between now and the peak, to add value by way of development, consolidate, declutter the portfolio by selling off assets I can't develop, cash up, refinance the whole portfolio, ready for the next land-driven downturn, to then have been a good, strong cash position and low debt position, to then start acquiring larger assets. And for me personally, moving forward, when I start acquiring again in the next land-driven downturn, I'm only going to be looking at blocks of units. So blocks of threes, blocks of fours, blocks of fives, sixes, that I can also develop down the track by way of even building out the back or knocking down and rebuilding high density. Thanks for watching. Hope this helps give you a bit more insight of what my plans are and how I am looking to trade the 18-year land cycle. Actually, also I didn't touch on stocks. I've got stocks and cash. I'll be selling all my stocks in 25, 26. I'll be getting my super out of investing in shares and putting all cash. So cash up, because when we go through the next land-driven downturn, the stock market will get cut in half, and so will everyone's super. So best to get it in cash to hedge your bets before the next land-driven downturn. As always, this is not financial advice, but I can guarantee one thing: if you don't take action, you won't get anywhere. Thanks for watching. Catch you next time.